Hi, everyone. It's a pleasure to be with you all this afternoon. Welcome to the 6th Annual Water Finance Conference. My name is Andrew Farr. I'm the editor of Water Finance and Management Journal. We are the producers and organizers of the Water Finance Conference. If this is your first time attending a Water Finance Conference, we're glad that you decided to take some time out of your day to join us. If you have been to a Water Finance Conference before, we're glad to have you back. I think this conference has really been gaining some interest from finance folks in the water utility space in recent years. So it's great to have everyone back. Obviously, this year is different. We're in this virtual online format. It's really been interesting to see our industry, as well as many others, kind of adjusting to these online conferences. It's definitely different. I think there's some good benefits to doing it, though. So we're really looking forward to it. I'm going to keep my introductions as brief as I can, so we can just get right into our first presentation today. You guys certainly don't want to listen to me ramble on, but I do want to start off by acknowledging a few of our sponsors. First and foremost, our main event sponsors this year. We have the National Association of Clean Water Agencies, which has really been a valuable sponsor and partner with us on this conference. I believe going on our fourth straight year, they've partnered with us. NACWA provides just invaluable resources to help us produce this event and really make sure that we're tailoring our agenda to the issues that utilities are dealing with on a regular basis. Our other main event sponsor this year, Synario, a really great company doing some interesting work in the financial modeling space, who you're going to hear from shortly. And then we have our session sponsor for today, Reptelis. I just want to talk through very quickly our format of these sessions this year. So we're going to start off each session with a half-hour presentation that will take us to about 1:30 Eastern time today, and then from 1:30 to 3, we will go into our panel discussion. And each of the other sessions for this conference, so session 2 happening this Thursday, same time, and then also next week on Tuesday, Thursday, same time. So each session will kind of generally follow that format, half-hour kickoff presentation to set the table on a particular topic for us, and then we'll move into a panel discussion. I do want to mention for our audience members on with us, you do have the ability to submit questions at any time. I'm going to encourage that you go ahead and do that. If anybody has any questions at any time for our presenters throughout the course of the panel, I really encourage you to do that. I can't promise that we'll get through every question if we get a lot in, but I will certainly try and get to as many as we can and make sure our presenters get to those questions. Right now, I'd like to turn it over to Chris Hornback, Deputy CEO of the National Association of Clean Water Agencies. As I mentioned, NACWA has been a great partner with us on this conference, and I'd like for Chris just to say a couple of words about NACWA and some of their work in the water finance space as it relates to their members. Chris?
Thanks, Andrew, and hello, everyone. On behalf of NACWA, I want to welcome you to the 2020 Water Finance Virtual Conference. This isn't exactly how we saw the 2020 conference going when we were talking about this last fall, but NACWA is nevertheless excited to be partnering with Benjamin Media, Water Finance Management again this year on the event. I know Andrew and the program committee have pulled together some really compelling presentations for the upcoming sessions, and I'm looking forward to hearing from the great lineup of speakers. The topics you're going to hear about couldn't be more timely. They are topics that we've been working on for months, in some cases years, in some cases decades. So they are very timely, and it looks like you guys have a great lineup of speakers over the next couple of sessions. So have a great event. I hope to see all of you in person soon, sooner rather than later, I hope. And with that, I'll turn it back over to you, Andrew.
Thanks, Chris. Yeah, it's great. It's great to have you guys involved in the conference this year. And just to echo a couple of things that you said before I turn it over to our first presenters. Um, we launched this water finance conference in 2015, and really the goal was to create a really a smaller conference that was a little bit different from what you might see at a session at a trade show. Kind of a more intimate setting is what we were trying to create, where we get an open dialogue between the conference participants and the audience, and really have kind of a candid discussion really about money in the water sector. There's a lot of different topics that we can cover in this space, and even though we're in this virtual format this year, I really am happy to have it for our audience. Looking forward to having our audience see this lineup of speakers and panelists. I really think you're going to be impressed. So with that being said, let me introduce our two presenters for our first half-hour block right now. We have Matteo, president of Synario. And just a couple of words on Brett. He's the managing director at the PFM Group, president of PFM Solutions, which offers best-in-class financial modeling software branded as Synario. Brett was a financial advisor in PFM's public finance practice, where he headed up PFM's higher education group and public power group prior to his current role. And we're also going to have Sam Lutz, senior solutions specialist with Synario, and he also currently works in the PFM Solutions Group powered by Synario Modeling Intelligence Platform. Sam's responsibilities include developing and implementing purpose-built planning solutions for colleagues in universities. And so Brett and Sam, you guys are obviously very involved in Synario's business on the financial modeling side. We had you on today to talk a little bit about our current situation with regards to financial planning and how utilities can look to plan for long-term sustainability kind of in this time of uncertainty. So Brett and Sam, we'll turn it over to you guys.
All right, great. Thank you, Andrew. Thank you, Chris. We really appreciate the introduction. We're really excited here on our side for the Water Finance Conference this year and for all the interesting topics that will be coming out for the presentations over the coming month. What we plan on discussing today is how to use a financial model to plan for many of the challenges that are confronting water utilities today. Our team here at Synario has been building financial models for over a decade. We've been helping our clients, and we've seen firsthand how a well-crafted financial model can impact the decision-making process for your institution. So with that, our conversation for today is to discuss how building.
Sam, do you want to put on the slides, please?
I believe we're on the second slide here. Oh, we can't see the slides.
Oh, okay.
Yeah. What we plan on discussing today is we are planning on discussing how to build a financial model in an uncertain environment and for a complex business such as a water utility, ultimately to lead to making the right decisions for your institution. With that, Andrew, thank you for the presentation. Just give a quick rundown of a little bit of our background here at Synario and what we do with the Synario Group. So my name is Sam Lutz. I work with our clients to develop and implement financial modeling solutions that help bring greater insight to our clients' organizations and ultimately leading them to make better decisions about their financial future. Brett?
Hi. Yeah, hi. Like I was described, I've been around for a while. I've been a financial consultant for many, many years, and I've been running this Synario practice for the last 5 or so. But I've been building financial models since the early 80s, and I've been building them for utilities since the late 80s. So while I don't purport to know all the nuances and subtleties of running or even modeling a water business, I do know something about building a financial model, and I know how to do it for utilities. So hopefully I'll be able to, impart a little bit of knowledge around what it takes to build a good financial model. And here's the underlying part that allows you to make some decisions. as opposed to simply have it on the shelf, kind of slowly reacting to whatever questions come over the transom. Sam, can you go to the next slide? Let's start with some acknowledgments. You folks know better than me that you run a really complex business. You have a long list of revenue requirements, including line items in there for debt and debt service, makes it really complex. And you have a rate structure that might involve volumetric charges or per unit charges, and you have that across a complicated structure of various classes, et cetera, et cetera. It makes for a tough projection because you need to figure out what your kind of organic business is going to look like in the future, but not as a snapshot. I mean, obviously, all your assumptions are constantly changing, so you need a model that can account for kind of an ever-changing list of assumptions and sometimes second and third order related assumptions related to that organic business projection. But at the same time, you're in the capital business. You have a huge capital structure with a long list of projects that your engineers have thought up. Maybe you have 5 or 50 or 150 projects on the docket. Each of those projects has a couple different permutations of cost. They can be gated differently, and they can be funded differently. It could be long-term debt. It could be commercial paper. It could be pay-go or WIFIA loans or SRF loans, or more likely some combination of all of those. And that will change from year to year to year. I mean, that's a little bit of a mess because it has to be thrown on top of that organic projection, which each has multiple versions. And so all of that then gets distilled into a series of metrics, and you have a lot of metrics to kind of keep track of because you have a lot of different stakeholders. So the board might care about affordability vis-a-vis the ratepayers, and maybe they have 2 or 3 board policies that they want to keep track of. I don't know, your ratio of swaps to debt or some such. The outside stakeholders like rating agencies might care about coverage, or they might care about days cash. You might have a private loan that is looking at a very particular covenant. The bottom line is this is a complex business model that you are dealing with. You know better than me, and you need a model that supports all that, Sam. And if that weren't enough, all that's happening, Sam, yeah, thank you, in an ever-changing environment. So there's regulatory changes, and you might have a consent decree, and then the population shifting, and the economy goes up and down, and you might lose a customer or gain a customer. Oh, and then there's climate change, all in a global pandemic. That makes for about as challenging a model building exercise as you could possibly ever expect. And so, Sam, go to the next page, please. So we asked the question, why build a financial model? You know the answer to this. This is why you built a financial model. Or if you didn't build it, you have a consultant that built it for you. You're in the business now of trying to answer kind of myriad questions that keep coming over the transom. The ground keeps shifting under your feet. If everything didn't shift under your feet, it would be a complex analysis of portfolios of assumptions and portfolios of capital plans, all kind of funneling towards certain metrics, even while everything's changing. And so I frankly don't envy you, but this is nothing you don't already know. You live this. And so there's nothing new. But what I want to try to impart is, even if you had that solved, and I don't think you did, my experience, all of your models, or even the ones developed by the rate consultants on your behalf, even if they're well crafted, they're not necessarily a decision tool, because I will contend that fundamentally they aren't structured in the way to make it a decision tool. And that's where I think you need to get to with your financial model. This is about decision making, not modeling for modeling's sake. And so to answer questions around your capital, even while the organic business is changing, even while COVID impacts this or that of the economy, even while in your part of the world there's a drought or not a drought, even while all that's happening, fundamentally your financial models, I don't think, are probably structured as a decision-making tool. Sam? So I believe that you folks probably have a way to establish a baseline projection. The best of your models, have a place, have an assumptions page, and you go in and you change the rate assumption growing at 2%. No, let's make it 3%. No, let's make it 3.5% next year and 4% thereafter. I believe that you probably have that fundamentally structured in your model. Let's hope so. And I know if you have a rate consultant, they certainly do. The ability to have multiple versions of those coexisting in a non-destructive way, however, is hard. And that's where I think the first problem arises in trying to structure a model that is a good decision-making tool. You can set a portfolio of assumptions and save it as version 1. And then you can set a new portfolio of assumptions and save it as version 7. And you can go on and on and on. And my guess is you have hundreds of versions saved on your file structure somewhere with different portfolios of assumptions. And that's a fine thing to do. But each of those changes in assumptions, unless you're driving macros and you have a bunch of different conditional logic, each of those essentially sits as its own version. And that creates a structural impediment to using them as a decision-making tool. To compare version 1 to version 46, you have to call the two up and create yet a third spreadsheet that compares one to the other. It's just clunky. And so fundamentally, setting up a model that is destructive in nature, where if you type a 3% change over top of last year's 2% change, you lose the 2% change. That's fundamentally problematic. I would say also that the best of your models, and I've seen a lot that are pretty darn good, probably can deal with all the initiatives and what ifs. You can turn a project on. You might have some conditional logic around folding in the new capital plan, version 1 or version 7. But again, once it's folded in, you kind of have to save it as its own unique version. And again, that becomes destructive in that sense. And so it doesn't allow for creative comparative analysis very easy. That's the first challenge. That's the most important challenge to solve. Figuring out a way, whether it's through macros or whatever, to allow for organic comparative analysis. And I say that's the biggest structural item that you need to build. Sam? So that it can be comprehensive and efficient and reliant and flexible. These are essential elements that you need to build into the model. So let's talk about how do we get there. That's all well and fine, Brett. How do I do it? Next page, please. Are you seeing it? Because I'm not, Sam.
Yeah, no, it looks like it's not on the screen for some reason.
Huh. Well, let me take a shot at explaining what this is going to be a little bit of a curveball here. And we have a hell of a graphic that you're not seeing right now. But the essence of getting the right fundamental structure in place to build the right model requires you separating the modeling from the reporting. You need a modeling regime and you need a reporting regime. And in most models that I see, and I've seen thousands over the years, they are one and the same thing, where you kind of look at the answer that is also happens to be the calculatory engine. And we believe that you need to separate those two things. Now let's just talk about the modeling regime. We think it needs to be object-oriented. And by that, I mean, very often, even if you have a well-crafted model where all the assumptions are kind of carved off to the side, or colored a certain color so you know it's an assumption, even if you're doing all that, the modeling logic very often is just a series of kind of pieced together with chicken wire and baling tape formulas. There's no consistent logic to it. You deal with one line item one way and a different line item another way. In fact, what that should be is a series of kind of copyable templates, if you will, what we call instances. And those instances should all derive from a certain template that we call an object. And you can craft this in Excel if that's your tool, but the logic should be consistent to cut down on the possibilities of mistakes. So for example, you might have a revenue object that is volume times a charge minus a discount of some type for a given rate class. But you have many, many different classes of payers that use essentially the same logic. well, then you ought to be replicating that formulaic block, whether it's 5 lines of formulas or 20 lines of formulas. That should be replicated over and over again in a consistent way. Same thing with expenses. If we're simply going to grow a given line item at a rate, that's a replicable block of logic, and you ought to treat it as such. You shouldn't go in and change everything line by line. It should be replicable object-oriented architecture that then rolls up to a summary section towards the top. That summary section, in turn, creates line items that are then ported over to the reporting regime. So fundamentally, this is very hard to show without the graphics, but fundamentally, you have a modeling regime that is object-oriented with series of logics informed by assumptions that roll up to collected line items, which are then ported over to a whole separate reporting regime. There should be an interface to capture data, let's say, out of your budget. You don't need stale data. We've all dealt with a board member who fixates on a given line item not being up to date. Well, you need to be able to freshen that. So each line needs to be able to capture, say, current actual data out of, let's say, the budget in real time so that the projections are fresh. And so therefore the reporting is fresh. It's critical that if you're going to make this organic projection, that you break it up into object-oriented modeling regime, separate and apart from a reporting regime. I'm afraid to ask you to go to the next slide, but let's try it. That comes up. Push another button. Oh, there we go. Why don't you push the button a few times? So there they are. So what we're talking about is a modeling regime, each with objects. Keep pushing, Sam. All right, it's not working. This is disappointing. Push the button a few times. Let's see what happens. So now the next aspect of this, which again, I wish we can show it to you, but is to collect assumptions for each version of the model into what are called cases. So somehow there are assumptions related to rates, there's assumptions related to expenses, there are assumptions related to capital and projects, and all your different revenue requirements. The idea is to capture all those in what we call cases. Those cases represent kind of a portfolio of assumptions that you need to be able to then mix and match into what are called scenarios. Now you might be saying, how do I do all this? How do I do all this? In Excel, you're doing it with conditional logic, sum ifs, count ifs, that are all attached to on-off switches, essentially. You should be in a position structurally to be able to grab different permutations of cases and create a scenario out of it. You should then be able to grab and turn on a different permutation of these assumption sets to create another scenario and yet a third, and then maybe a fifth or a 10th. In doing so, what you craft is the essential elements of a decision-making tool. The problem with the way most models are constructed right now is that a given set of assumptions are set and saved as a version, and a different set of assumptions are then set and saved as yet another version. It doesn't make for an organic view of the answers. And by that, I mean, it's sort of like watching a football game through a rolled up newspaper. You can set a whole bunch of assumptions in your Excel model, and it's like looking at the left side of the field through your rolled up newspaper. It's like a snapshot of what's possible. You then change all the assumptions and you look to the right side of the field through your rolled up newspaper. You're seeing an answer, but it's just one answer. It would be a lot richer to finding the right answer if you could look at the whole field at the same time. To do that, you need the ability to kind of turn on to craft different scenarios in a live way. You can't be in the business of calling up version 125 of the model and then version 75 of the model and then version 200 of the model. They all should kind of coexist and allow you to mix and match in real time and do that comparative analysis in real time. I believe it's possible. I have built these models in Excel. It's complex, but you should strive to create all of your modeling should strive to create organic views that can sit side by side at the same time. It's important that you have the ability to line up the possibilities side by side by side. And I think if you're in the business of constantly calling up different versions of the model, that's not possible. It creates a very snapshotted version of the future. And what you need is the ability to see between the snapshots, kind of all the frames in the movie, if you will. So this has been a little challenged by the fact that we haven't been able to actually look at some of the slides. But the bottom line is there is a structural element to your model that may or may not exist. I suspect it does not, where you are setting individualized sets of assumptions and saving them. And what I would contend is you have to aspire to build a more organic view of things where you can have multiple versions of the exact same projection all coexisting in the same model at the same time. In Excel, that's going to require a very structured environment with conditional array formulas, on-off switches. There's other software, I sell it, that is kind of structured to do that very thing. The key is whether you're doing it or your rate consultants do it, you have to strive to make it into a decision-making tool. And a decision-making tool is not 200 versions of a model saved on some drive somewhere. It's critical that you don't get caught in the endless decision cycle that most of you are trapped in. Sam, go to the next page. Whereby, the board or some stakeholder asks a question, usually of the CFO, and the CFO then defines a series of scenarios to answer that. And you're the poor folks who have to go off and try to wrangle that Excel model to the ground, wrestle it to the ground and get the answer, feed it back to the CFO, who no doubt has some tweaks. And then finally, you extract the answer into a PowerPoint slide and bring it off to the people who asked the question. And by the time you bring it to those people, the question has changed or the world has shifted under your feet. And so you go into this loop, and it's not coincidental that we made that an infinity sign, where you're constantly playing catch up, where at best, you can wrestle that question to the ground in 2 hours or 2 days or 2 weeks and bring it back as a PowerPoint slide. That's not a decision-making tool. That is way too clunky to kind of get the planning done that you need to get done. And so all of this goes back to what does your model, how is your model structured? How do I make it a more linear decision process? How do I get the modeler to get the CFO the organic answers he needs in a comparable form so that the decision makers can make their decision without that endless loop? Now, I'm going to stop talking, but I have to apologize for the snafu on the slides. I don't know what that's all about. And I'm sorry if this whole presentation certainly threw me a bit of a curveball here. And I don't know if I dealt with it as gracefully as I could have, but I hope you get the idea of what I'm trying to impart. And if not, give me a call and I can explain it to you, perhaps with slides. So with that, I'll stop and ask for questions.
All right, Brett, Sam, great presentation. Thanks very much. I believe the attendees on our end, we could see the rest of your slides popping up though. So if it was maybe a delay on your end, we could see them. I do want to get to a couple of questions though. Can you guys talk a little bit about some of the consistent challenges that you get when you are having conversations with finance managers at utilities, with CFOs? What challenges are they having with either their model or a model that you need to build for them? What are they trying to address consistently in regards to, I guess, kind of their broader financial planning, future rate setting?
I'm going to have to answer this in the abstract because I'm not one of the modelers who actually does this for a living. So I can't answer it in terms of the specific water questions that are being answered. But in terms of the modeling, the CFOs, I mean, if you think about the number of possible organic outcomes of that need to be projected, there's an infinite number of possible rate increases and expense increases going forward. And so the complexity around that is remarkable. And then at the same time, like I said, there's sort of an infinite number of ways to roll out your capital plan and fund it. And so infinite times infinite makes for a lot of possibilities. In my experience, most CFOs have trouble wrangling that problem. They lean on their staff, and it becomes a whole series of, what about this one now? Try this, try that. And version control becomes a real issue. There becomes way too many possible views of the future to understand, let alone make a decision about. And so for us, what it becomes is a structural matter. How can you give in real time, a CFO the ability to kind of separate the wheat from the chaff, to whittle down all of those endless possibilities to the 2 or 3 or 5 that might be real? How do you whittle it down to that? How do you define the edge of the envelope? That's really hard when you're doing discrete analysis. Set a set of assumptions and save it. Set a set of assumptions and save it. Discrete analysis like that creates for suboptimal decision making. If you could somehow create a continuous function, hopefully in real time with the CFO. So instead of him going off and saying, can you please answer this question for me and bring back the answer? If you could sit in a room with them and change assumptions in real time and reset the capital plan in real time, and then change, oh, what if we increase rates 3.5%? What if we only do it for commercial customers? What if we have to slow down the capital plan even while we're increasing rate? What if you can do that in real time and separate the kind of the dumb solutions from the smart solutions? That's the key to really kind of getting at the answer. And in my experience, CFOs are kind of annoyed's too strong a word. They're hamstrung by the tools at their disposal. No matter how good their modeling staff is, no matter how good their analysts are, no matter how good their rate consultants are, I might add, because the rate consultants are simply doing the same thing for a fee, wrestling that Excel model to the ground. They're at a loss as to how to solve this because the tools are a little bit clunky. That's what I see.
Okay. Brett, I have another question that I wanted to ask you, but I do want to, we're going to get ready to move into our panel portion here in a minute, but I'll throw one more question at you. And this is a question that I think is going to come up during some other of our sessions throughout this conference. Perhaps on Thursday, we're going to have a panel discussion on revenue recovery and data intelligence. And what I wanted to ask you was, I guess, in reference to, a big theme in the managing the modern water utility, if you will, is technology implementation. A lot of utilities, they're looking at upgrades to their metering systems, SCADA, GIS, 3D modeling, hydraulic models, all this new technology to give them better insights about how their technologies or how their utility is performing. I'm wondering how some of that data is factored into a financial model, if at all. If these technologies are based on providing a utility with cost savings, how is that factored into future financial planning? Can you speak on that at all?
Well, all right. So we're out of my depth, but I can speak to it as a modeling matter. All those technologies are meant to drive efficiencies or capture information differently, and there may or may not be a financial impact of that. If there's a financial impact of that, I know this. You don't know exactly what it's going to be. There's going to be different versions of that financial impact on one line item versus another. There might be many line items affected by that technology, and then there'll be multiple versions of how those line items are affected. It speaks to my prior point. Whatever those technologies are, to the extent they have a financial impact, hitting one or more line items, you're going to have multiple versions thereof. And so you need to be able to capture that in real time and be able to do comparative analysis around that without destroying the prior version. That is the key in being able to decide whether or not this technology or that technology has legs, whether the answers we're going to get from that technology or the improvements we're going to get from that technology merit the cost, whether or not, even if we implement that technology, what does it mean for my business going forward? The key is being able to see kind of between the snapshots, all the frames between the snapshots. And these technologies allow for kind of a lot more frames, but then you need a financial model that can deal with more frames. I guess that's the way I would think about it.
Yeah. One more question, Brett. We had a good one come in from the audience, so I want to throw this one at you really quick. Is Synario seeing utilities start to model with assumptions involving large number of payment defaults from customers due to unemployment from COVID?
No, I'm not our client base, not yet. I mean, hopefully never, but not yet. The defaults would be interesting to model, though, right? Because there's an infinite number of permutations of how that could play out. So again, it goes kind of to my prior point. Structurally, you need a model that can deal with infinite permutations.
Okay. Well, Brett, Sam, once again, thanks very much for the presentation. If anybody else is still submitting questions or has any others that you'd like to submit, go ahead and continue on doing that, and we will make sure that Brett and Sam answer those offline. For all of our attendees on with us, we're obviously going to move into our panel portion now. So I will be getting with our panel, and we will see you in just a minute. So thanks, Brett, Sam.
Thanks.
Appreciate it. Thank you, guys.
Thank you.